Aman Chauhan joins us. Abacus Asset Manager is the fund which he represents, and me and Aman have been good friends for almost 20 years now. It's so nice to see his journey evolve from an analyst to now a senior fund manager. Aman, so nice to have you back on our channel in this avatar.
Hi, Nikhil. Morning to you and your viewers. Nice to connect with you.
So I'll keep it very simple and straightforward. That's what we always do when we meet.
Mm.
Keep it simple and straightforward. Where are you shopping right now, and where are you selling right now?
Mm, Mid-size private banks. That is one area which we are very excited about as we speak. Some select NBFCs, which are market leaders in the segment. Um, Building materials. We don't have direct estate exposure. This is a segment which is seeing an upswing, which is going to stay for at least a few years for now. So we are indirectly playing it through building materials. So we have plywood companies, laminate companies, MDF companies. So that is one segment that we are pretty positive on. Uh, IT, we are neutral. We are not sold anything. We still feel that even if there's a global position, the best way global companies can cut costs is by outsourcing more to India. But in the near term, uh, momentum is not there because there is a margin pressure, and hence we are neutral on IT. Uh, Auto Angs is what we like. Cap goods is also what we like, but the valuations here are mostly beyond the comfort zone. So we are very selective in that segment. So that's broadly some of the sectoral picks that we have currently.
Why are you bullish on mid-tier banks? Because some could argue and say that okay, they are cheap, but they could remain cheap because bulk of the deposit, bulk of the brand, bulk of the technology, and bulk of the customer migration is happening in big banks.
Big banks.
So why do
Yeah.
you like small banks when they are not getting strong deposit franchise and when they are not gaining market share?
Yeah. So there are almost 20 small banks in India, after which only a select top three, four is what we like. And the reason is that they are all trading closer to book value or at a decent discount to book value. And with the NPA worries behind us, the ROA and the ROE profile is improving. So if the ROA touches one and the ROE goes beyond 12, 13%, there is no reason for them to trade below book. They'll trade at least one time book, which is also doubling your money over a 2 year time frame, which is a decent risk reward equation to have. And in the current circumstance, when your large banks, we already own most of the large banks also, but incremental buying is now getting into the mid-tier banks with a very clear reason that uh, traction is coming in. They might not gain market share, but what will happen is there's consolidation within the mid-tier banks. Out of those 20 banks, 15 are losing market share, 5 are gaining market share within them. Within the larger banks, they are not competing directly. So these are all niche banks that are confined to a specific region or some few sectors, and that is where they are gaining market share in their own segment. So that's the reason. So we're not buying across the board. Only the top tier mid banks is what the focus is.
The AMC which you represent is the AMC which in a sense has a tilt towards small and mid cap stocks. You look outside the index. So is there a compulsive factor when it comes to mid cap auto ancillary, mid cap banks, mid cap construction stocks? I mean, is it the mandate which you have to stick to, or this is somewhere you would have bought into irrespective of your mandate?
So we broadly run two strategies. One is the all cap strategy, which is a combination of large caps and mid caps. In this, we have larger private banks also and select mid cap banks, and that is true for other sectors also. And the other strategy that we have is the dedicated mid and small cap. So here we look only at the mid market to small market. So it also depends on the strategy, but overall, as I mentioned, we do have large banks with us. We have been owning them since long, and besides the top two largest private banks, we would be owning the next number three, number four, number five in our portfolio. We also have the largest PSU bank in our portfolio. Incremental buying now is getting more to that because of the valuation. So the large banks are all trading north of 2.5 time book, and the mid banks are now anywhere around one and below one. So there is a decent valuation gap between the two, and that is the reason incremental buying is happening more towards the mid-sized private banks.
Auto is where you would say that there is disruption. Some large companies will become mid cap companies, and some mid cap companies will become large cap companies as this entire electric vehicle rollout happens. How are you picking your spots? Because in the beginning, you mentioned that you're also bullish on mid cap and auto ancillary.
Sure. So in autos, we are confined to the two-wheelers because this is the space where the existing companies will be able to migrate to the EV. For the four-wheeler, there's only one company where the EV clarity is not there, when and how good the EV launch could be, and they could be losing market share to the new incumbent. So exposure is limited to two-wheelers. And within the auto anchor, the call is pretty simple. Stay invested only in those companies which have a EV portfolio, or which have a portfolio which is not going to get impacted with the EV. It's a writing on the wall. It's just a matter of time. We could be off by 1 or 2 years, but eventually all two-wheelers and all four-wheelers are going to be EV. So you need to be on the right side of disruption, both as well as the OEM is concerned or the auto anchor is concerned.
How convinced are you about IT, given that every time historically the world economy has slowed down, with a lag effect, it has impacted IT outsourcing, whether it is the 2001 experience or the 2008 experience. Today, companies are denying it, but my issue with IT companies is that they themselves may be not aware of it. I mean, that's the reason why each quarter the commentary also changes.
Yeah. Yeah, so it's an evolving world. It's a very dynamic world. IT companies also respond the way the clients respond to them. So as of now, the commentary is that the demand is strong. They are seeing it's more of a supply issue than a demand issue. And at the same time, they all are saying that this is visibility for the next 2 to 3 quarters, post which, depending on how the global economy works, we will be guiding. Uh, the reason I'm pretty confident is two. One, cloud migration and post-COVID investment into digital is a trend. The way we have a housing trend which is going to sustain for the next few years, this cloud migration and digital networking trend is going to sustain for the next few years. Any corporate, large or mid, would now want to have a robust IT system which can be connected, where people can work from home and all the offices are connected, and they need to have a cloud presence. So this is a mega trend, and Indians are benefiting. Also, COVID taught the whole world an Indian IT model is not just about cost, they can also deliver remotely efficiently. So it's a given that Indian IT companies will continue to gain market share. So my call is that even if there's a recession or stagflation or depression or whatever word you use for the global world, uh, in that scenario, what happens is that the countries or the companies are not closing down. There's a slowdown. What happens in the slowdown? In slowdown, you cut costs. And there's no better way to cut costs and no efficient way to cut costs than by outsourcing to Indian IT companies. There can be 1 or 2 quarters of hiccups, definitely. But demand outlook, at least in the next few years, is pretty strong. That's broadly what our view is. What does happen is that when trends change, the P's compress. You see the mid IT stocks, or even the large IT stocks, they were all trading north of 40p. That 40p has now become 20p because the outlook and the margin outlook has changed. And we see the price. If you see the reported earnings growth, they are all strong. Even if the prices correct further from it, the earnings growth is going to remain strong. That's the call. So somewhere this earnings growth and P have to converge. And maybe in the next 2 quarters, I feel that convergence is going to happen.
Okay, Aman, where do you think right now gold is selling at the price of diamond, which is that as a fund manager, you like the company, you like the business, but it's not a good stock to own?
Uh, Pharma, uh, lots of good business models, lots of good companies, valuation is good, but there is no near-term earnings growth. One, because of the high base due to COVID, and because of the pricing pressure we are seeing in the generics market in the US. So for the next few quarters, at least, pharma is one space where one needs to keep the eye on. Maybe not jump in right away, but definitely keep your eyes and ears open, and just wait for the right time. So great businesses, globally scalable businesses, uh, and great management. Just that near term investor interest is not there, and rightly so, because the earnings traction is not there. But it's a matter of time; it will come back. It's something similar to auto and auto anch. Few years back, nobody was looking at them. Last 3 4 months, they are the best performing stock. Same thing happened with capital goods. There is a time when the same thing happened with pharma also. This is one space where I'm also currently not deploying fresh capital, but definitely something which is on our radar.
Just to wrap it up with this entire template which Sunil has used, 15, 15, 15. 15% return ratio, 15% growth, 15%, 15 P,
P, less than 15 P.
less than 15 P.
Yeah.
What else qualifies in that apart from banks and auto ancillary?
So the framework that you mentioned definitely is what we look at, but at the same time, we say that any two out of these three criteria should be met, not all three, because if all three are met, then we are having a great company with a great growth, with a great valuation, which practically doesn't happen. So it goes only on paper, practically it doesn't happen, and hence we said any two out of the three criteria should be met, and the one which has not been met should at least be visible. So keeping this criteria in mind, valuation is something still is mostly off in the equation. Markets have rallied. At 2 months back, if you had the same discussion, I would have told you a long list. Today, the list is not very long, but select auto anch stocks qualify in that, banks and BFCs qualify in that, uh, pharma companies are qualifying that. There are few chemical companies also, because what has happened in the near term, because of the supply disruption or because of pricing disruption, earnings have got hit. So there's few chemical companies also, not the SRFs or not the top guys, but one of few agrochemical companies would be fitting to that criteria. So it's difficult to tell you which sector qualifies, but within every sector, there's a select stack of stocks which qualify in this parameter.
All right, Aman, fantastic to have you, and certainly hope to see much more if you're going forward. So good to see you, my friend. So good to see you. I mean, we've interacted on the record, off the record, as friends, as family members. So good to see and see your journey evolve.